We are going to go over the different types of businesses, business comparison. The first one will be the sole proprietorship. It is basically started by one owner who just starts doing the business that he wants to form by doing the action that forms the sole proprietorship. There is no formation required. There's no filing with the state or any filings. It's very simple to form. It's the most common form of business in the United States. It has full management authority, few formalities and reporting requirements, low cost of organization. It's just one person. The benefit of the tax, where it reports income on personal return and pays tax accordingly. And it's ease for discontinuing of the business. There is unlimited liability for the sole proprietor. However, just because the sole proprietor has sole management, the disadvantage is that there is no diversity in the management. So it's basically the one individual that is doing all of it. He can delegate, he can hire employees, and have agents to act on his behalf, but ultimately it's the sole proprietor. It lasts the duration. It ends with the proprietor's death or withdrawal at will, as long as he wants to do the business, and the business will stay operating. Next will be the general partnership. It is formed with two or more owners to carry out the co-owners of a business for profit. All the partners of a general partnership are general partners. There's no formalities required. However, it is suggested that a written partnership agreement be required. The partnership is considered a separate entity for most purposes. Each partner typically has the right to act on behalf of the partnership when dealing with partnership business. All partners have equal right to manage the partnership unless otherwise agreed in the partnership agreement. So if one partner wants to decide to buy a certain product as long as it's for the business, he can act on behalf of the partnership and form that relationship and conduct business. However, certain things outside of the ordinary course of business require the unanimous consent of all the partners. Each partner has the right to receive an equal share of the profits and the responsibility to pay those losses and equal share of the losses of the partnership. Income allocated among the partners who pay tax at a personal rate. There is no personal liability. However, the partners owe a fiduciary duty to each other and to the partnership. That duty may be expanded and detailed in the partnership agreement, but their duty cannot be diminished under the partnership agreement. The partnership agreement is essentially understood to be, it's considered the law of the partnership for most purposes. The liabilities of the partnership must be paid before final distributions can be made to the partners of the dissolving partnership. It will last the duration. It's indefinite. It may dissolve on death or withdrawal of partner unless otherwise agreed in the partnership agreement. Next is the limited liability partnership. It's also formed with 2 or more owners. The statement of qualification must be filed at a state level. So it's not as easy to form a limited liability company simply by turning the power on at a law office and opening the door up. You actually have to file at a qualification at the state level for the limited liability partnership to be formed. All partners have equal right to management partnership unless otherwise agreed in the partnership agreement. Again, the partnership agreement is considered law under a limited liability partnership. So oftentimes, basically the rules will be in the partnership agreement as to the details of what owners can and cannot do in the partnership agreement. The income allocated among partners who pay tax at a personal rate. There is also, it was first designed, a limited liability partnership was first designed for professionals who provided services as partnerships. It's generally still for that purpose. They do offer a partial shield statute, and whereas it protects the partners from personal liability for the negligence and wrongdoings of other partners, there are also full shield statutes where it protects the partners from personal liability for all debts and obligations of the partnership, although a partner may still be personally liable for his or her own wrongdoing. The duration of a LLP can be indefinite. It also may dissolve on death or withdrawal of a partner unless otherwise agreed to. The other partners can buy out the dissolving or the withdrawal of the partner's part in the business, so that the limited liability partnership doesn't just dissolve simply because one partner is withdrawing. It can continue to operate under those purposes for all intents and purposes. Next will be the limited partnership. It's comprised of 1 or more general partners and one or more limited partners in order to form a legal separate entity. Very much like a general partnership. The driving concern, however, is that usually protection from liability and the ability to distribute funds among many of the shareholders that would otherwise would not be possible under a standard corporation. The general partners are responsible for the daily operations of the company and are personally liable for its obligations and debts. To absorb the liability, is to invest the capital in the company. The limited partners invest capital in the company and share in the profits, but take no part in the daily operations. Their liability is limited to the proportion to the amount of capital that they invest. Take, for example, I see a tract of land of a developing area. I plan on building profitably 10 homes on the property, but I don't have the money to do it. So my friend Sally has the money to invest, but doesn't know how to develop the land. So me and Sally form a limited partnership that will allow Sally to limit the liability but contribute to the capital in exchange for the interest in the limited partnership. I act as a general partner and manage the development and the construction of the homes, preferably to take liability protection just a little further, and I would then incorporate or form a LLC to be the general partner. Next is the limited liability company. It has a minimum of 2 owners in some states, but there's no maximum number of owners. It can be a single member limited liability company, but they are highly disregarded as a separate entity for tax purposes. To form, articles of organization must be filed at state level. Again, they can't just rent an office building, open up the door, and pay the power bill and say, here we are. They actually have to file an articles with the state for the business to be formed. All members have the right to participate in the management of business unless it's agreed upon in the articles of organization. The management is often delegated to the board members. It has characteristics of both partnership and a corporation, and the owners of the LLC are often referred to as members. It may be a member managed or manager managed. The LLC is formed when articles of organization are filed. Again, it's at a state level, so it's a little more regulated than even a sole proprietorship or just a general partnership. Members of the LLC may choose to be taxed as a partnership or as a corporation. Members of the LLC act as agents for the limited liability company. An LLC is a business structure that combines the pass-through taxation of a partnership or a sole proprietorship with the limited liability of a corporation. The LLC is designed to separate the business assets. Basically, you can open up, file the business with the state. You get your own tax ID and your own bank account, and you just are operating under the business from the personal assets of the owners or the members, which has the effect of insulating the owners from the LLC's debts and liabilities. Losses can be used to offset other income, but only up to the amount that's invested, and the LLC only files an informational tax return. In terms of transferring the business, a business continuation agreement is the only way to ensure a smooth transfer of interest when one of the owners dies or leaves the business. To absent a business agreement, the LLC must be dissolved in the event of bankruptcy or the death, and the duration of the business is perpetual in most states, unless, again, just as I just stated, that unless there's a continuation agreement where one member leaves or dies. The last is corporation. There are no or very few restrictions to a corporation. Again, you can't just form a corporation by renting a space. You actually have to file the articles on the state level. And the shareholders elect the board of directors to oversee the management, so it's not as flexible with the management. Corporations are considered separate entities from their owners. One great benefit is the limited personal liability that's offered to the corporate owners, directors, and officers. The corporate entity may be disregarded when the court finds it's necessary to prevent an inequity, injustice, which is also considered piercing the corporate veil. They're a little more regulated than the sole proprietorship, as example. They're regulated subject to common law, case law, and federal law. As a separate entity, they enjoy the certain rights and powers that are typically prescribed by the state statute. And again, it's perpetual as well. One last thing with corporations. Corporations are responsible for tax on corporate income. The shareholders are responsible for the income on the tax. It's a little more regulated, not as flexible in the management of the details of the corporation.